Today, snakes and ladders as inflation bites. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. US stocks closed lower on Thursday as investors weighed surging US consumer price inflation and the stalled Russia-Ukraine negotiations. Inflation accelerated for a sixth successive month, and the Russian attack on Ukraine showed no sign of letting up. Oil declined and the dollar rose. Markets have whipsawed since Russia invaded Ukraine 2 weeks ago, with US stocks this week experiencing the biggest swings of gains and losses since 2020, a game of snakes and ladders. Commodity prices have also gyrated as investors grapple with uncertainties surrounding Russia's attack on Ukraine and supply disruptions, while inflation continuing to bubble away is putting pressure on policymakers to hike rates and threatens to curb economic growth. US consumer price gains accelerated in February to a fresh 40-year high on rising gasoline, food and housing costs, with inflation poised to rise even further following Russia's invasion of Ukraine. The consumer price index jumped 7.9% from a year earlier, following a 7.5% annual gain in January. The widely followed gauge rose 0.8% in February from a month earlier, reflecting higher gasoline, food and shelter costs. Both readings match the median projections from economists beforehand. Excluding volatile food and energy components, the so-called core prices rose 0.5% from a month earlier, and that translates to 6.4% from a year ago. The figure shows how an inflation cloud is hanging over the economy, and it's proved to be more persistent and expansive. The price spike has pushed the Federal Reserve to end 2 years of near zero interest rates, likely starting with a quarter-point hike next week. It's also sunk President Joe Biden's approval ratings ahead of November's midterm elections that may cost Democrats their thin congressional majorities, especially as inflation is outpacing wages growth. While February was once forecast as the peak for US inflation, now readings are set to rise even further, probably to above 8% according to some economists. That's because the Ukraine war and Biden's ban on Russian energy imports tightened oil supplies and sent prices of US retail gasoline and other commodities to some of the highest on record this month. Inflation is not likely to roll over and begin to come down for several more months, Michael Gapin, chief US economist at Barclays, said. This sets the stage for where we are now, and we will need to see how long this conflict plays out and how disruptive the sanctions regime actually is. The geopolitical situation adds uncertainty to the central bank's hiking cycle over the coming year. Fed officials could take a more hawkish stance if energy shocks lead to higher and more persistent inflation, but they may also take a more cautious approach if sinking consumer sentiment and declining real wages begins to weigh on growth as the war drags on. The February CPI data showed that gasoline prices climbed 6.6% from the prior month, and that accounted for almost 1/3 of the monthly increase. Some of that may reflect energy price spikes resulting from the first days of Russia's invasion during the last week of the month. The impact, though, will be more fully captured in the March CPI report. So far this month, the regular price of regular-grade gasoline has increased 19.3% to $4.32 a gallon, according to the American Automobile Association. Food prices climbed 1% from the prior month. That's the largest advance since April 2020. And compared with February last year, the 7.9% jump was the biggest since 1981. While the war's full impact on the US economy remains unclear, soaring costs of oil, grains and metals are likely to feed through to other commodities and ultimately consumer prices. The Biden administration on Tuesday banned Russian oil imports into the US, a move that will add to energy price pressures. Wage increases as a result of a tight labour market haven't been keeping up with inflation. Inflation-adjusted average hourly earnings dropped 2.6% in February from a year earlier. That's the largest drop since May and the 11th straight decrease, according to other data released on Thursday. The report showed that prices for merchandise continued their climb in February, while annual growth in services costs accelerated. On a year-over-year basis, goods inflation rose by 13%, the most since 1980. That included the largest ever annual increase in prices for new cars and trucks. Service costs increased 4.8% from a year ago. That's the biggest advance since 1991. And US inflation has broadened out across multiple spending categories. Shelter costs, which are considered to be more structural components of the CPI and make up about a third of the overall index, rose 0.5% from the prior month. That's the most since November. And rents of primary residences increased 0.6% on a monthly basis, and that's the largest advance since 1987. Motor vehicle repair costs shot up by a record 4.3% in January, and an index of personal care jumped up an unprecedented 1.2%. The price of hotel stays and airfares rebounded in February following the Omicron-related pullback in economic activity in December and January. So where does this all take us? Well, the global economy is at a mounting risk of stagflation and potentially more recessions as fuel, food and metal prices surged after Russia's invasion. Fresh speculation that governments may slap sanctions on Moscow's energy supplies catapulted oil above $130 a barrel at one point on Monday, and European gas prices continue to fly higher after doubling last week, and wheat is near a record following Ukraine's exit as one of the top global crop suppliers. Copper, palladium and other metals are also still rising. With the world still to fully escape the coronavirus and supply chains fraying anew, the climbing cost of raw materials increasingly threatens a 1970s-style twin blow on companies and consumers via even faster inflation and weaker demand. Natural gas from Russia in 2020 flowed to many countries in Europe, though data for 2020 was not available for the UK and Bosnia-Herzegovina, where 2019 data has been shown. Norway imported 10 million cubic metres of gas from Russia in 2020, but as a net exporter is not dependent on Russian imports. So in question more broadly is whether economies will suffer stagflation or another recession just 2 years since the pandemic forced the deepest slump in decades. Europe, which uses Russia for about 40% of its gas needs, is at particular risk, although the US and Asia aren't immune either. Economists at Barclays and JP Morgan Chase are among those lowering forecasts for global growth and raising them for consumer prices. Both expect expansion about a percentage point weaker and inflation a percentage point stronger than previously. Soaring commodity prices and increased risk aversion caused by the Russia-Ukraine war imply a stagflationary shock, the Barclays economists, led by Christian Keller, wrote in a report. While Europe looks more vulnerable than the US and the UK is somewhere in between, China seems least exposed. Stagflation would sharpen trade-offs between expansion and inflation, and governments are under pressure to offset pain via greater spending, for example with subsidies to protect the poor from high energy costs. And meanwhile, central banks will have to tread carefully, even as the US Federal Reserve still seems set to raise interest rates. The Fed has no choice but to hike in March, and we believe they will keep hiking beyond that, despite the geopolitical risks, Jefferies economists said in the note. A 7-hike scenario still seems like a reasonable base case. Now, it's worth noting the IMF is warning of very serious economic consequences from the war, and Goldman Sachs estimate a sustained $20 shock in the oil price will lower gross domestic product by 0.6% in the euro area and 0.3% in both US and China. Cutting off gas shipments through Ukraine could knock 1% off euro area GDP, while an entire loss of Russian gas would mean a 2.2% hit, they reckon. And a complete shutdown of Russia's $4.3 million barrels of oil a day exports to the US and Europe would reduce global GDP by 3 percentage points. Other than Russia, Ukraine, and neighbouring economies in Europe's east, euro area nations appear most at risk. Based on assumptions of energy prices at their new highs reached on Monday, it's possible that the euro area could show a contraction in the third quarter and a 6% inflation this year. And while inflation there is already at almost 6%, triple the European Central Bank's official target, officials may choose to focus on supporting growth for now. In fact, the European Commissioner for the Economy warned last week that high energy prices will likely weigh significantly on growth. Exactly how badly the European economy will be hit is anyone's guess at this stage, but the post-COVID recovery will surely be significantly delayed, Eric Nielsen, Chief Economic Advisor to UniCredit Group, said. He sees a risk of stagflation, if not even a recession, with inflation. Even more pessimistic was Giles Malik, Chief Economist at AXA Investment Managers, who said losing a percentage point of GDP growth this year now looks optimistic. While Asia has broadly swerved the inflation seen elsewhere, the sudden surge in energy prices will flow through to consumers in a region that's a net importer of oil, potentially hitting manufacturers and exporters. And consumer prices and production costs in Asia have been accelerating even before the Russian invasion, and the region is vulnerable to higher food costs. For much of last year, price pressures have stayed relatively muted, said Frederick Newman, co-head of Asian Economic Research at HSBC Holdings. The cyclical outlook for 2022, with growth expected to remain soft, also didn't point to any hurry to raise rates. Well, that's starting to change. Now, there are some shock absorbers. The Omicron variant is in retreat. Households and businesses built up savings during the pandemic, and most labour markets have tightened. China is also targeting growth of about 5.5% in 2022. That's the higher end of many economists' estimates. But it wouldn't be the first time that rocketing oil prices have hurt global growth. A doubling of the crude price in 1973 to 74, 1978, and 2007 to 8, all pre-staged recessions. But adjusting for inflation, it would need to exceed $170 to surpass its 2008 record, according to the National Bank of Canada. Paul Donovan, the global chief economist at UBS Wealth Management, said the overall result may only partially resemble the 1970s stagflation. And while exporters of oil will benefit, they spend much more nowadays than in the 1970s, which will support global demand, he said. Meanwhile, households may also respond by turning down heating and air conditioning and by eating in rather than dining out. Lower consumption demand could bear down on prices, Donovan said. Businesses can also find efficiencies. UK factories are already temporarily halting production during peak daily energy demand and restarting when electricity prices drop. And it's also worth noting the world is less reliant on crude than it once was. With global goods trade at record levels, the hit to consumer demand will potentially lead to a production overhang, which will also bear down on prices, Donovan said. We're not going to see anything as severe as the 1970s, he added. So coming back to the markets, the S&P 500 ended down but well off session lows, with tech stocks leading the retreat. Treasuries fell across the board, sending the 10-year Treasury yield to levels not seen since February the 25th, and the 30-year rate to the highest since May 2021, after data showed inflation running at the fastest pace in 40 years. Oil dropped below $107 a barrel in New York amid concern that surging prices could hasten the onset of demand destruction. The market likely already priced the inflation increase in accordingly and is instead intensely focused on Ukraine and the downside impact from commodities, which are already sending shockwaves through the market, said Mike Lowengrath, Managing Director of Investment Strategy at E-Trade. Bottom line for investors is strap in for a bumpy ride, but keep your wits about you and don't react emotionally. Now, Ukraine and Russia failed to make progress in halting the war and bridging the vast differences between them at the first high-level talks between their foreign ministers since the Russian invasion began. Sentiment was boosted on Wednesday after a top foreign policy aide to Ukraine's president said the country was open to discussing Russia's demand for neutrality as long as it was given security guarantees. And while the jump in US consumer prices was in line with forecast, it reinforced expectations that the Federal Reserve next week will start raising interest rates to contain inflation that some economists now see rising above 8%. That's because the Ukraine war and US President Joe Biden's ban on Russian energy imports tightened oil supplies. On top of that, a reading of inflation that came in at its highest level in about 40 years underscored the surge in prices in everything from dry commodities to crude oil. The Dow Jones Industrial Average closed down 0.34%, the S&P 500 closed down 0.43%, and the Nasdaq Composite was 0.95% lower. Oil prices have cooled off in the past two sessions. On Wednesday, WTI and Brent slid more than 12 and 13% respectively. WTI fell again on Thursday to around $106 a barrel, while Brent slid 1% to nearly $109 a barrel. The violent gyrations of the market seems completely attached to Ukraine-Russia peace talks and the subsequent volatility of energy costs, said Timothy Lesko, Senior Wealth Advisor at Marine Wealth Advisors. The fall in commodity prices on Wednesday seemed to trigger a relief rally that is unwinding a bit as peace talks seemed fruitless. Energy stocks, Chevron and ExxonMobil, rose 2.7 and 3.1% respectively. Other commodities that have seen significant rallies since the war in Ukraine that pulled back on Wednesday were higher again on Thursday, and silver and gold rose as investors worried about the impact of high prices on economic growth. Amazon shares jumped 5.4% after the company announced a 20-for-1 stock split and a $10 billion buyback. CrowdStrike rallied 12.5% following an earnings beat and raised its outlook, and elsewhere in tech, it was a sea of red. Zoom Video fell 5.3% and Microsoft did 1%. Apple and Meta Platforms fell 2.7 and 1.7% respectively, and Tesla was 2.4% lower. Goldman Sachs dropped 1.1% after announcing it was shuttering its Russia business, becoming one of the first major global investment banks to do so. And JP Morgan made a similar announcement on Thursday afternoon. JP Morgan fell 1.2%. The US 10-year Treasury yield broke above 2% for the first time since February 25th. And traders also weighed the European Central Bank's decision to unwind stimulus measures sooner than expected. The bank said on Thursday that it will end its bond buying program in the third quarter of this year if the economic data allows for it. The ECB's decision comes ahead of next week's Federal Reserve meeting, where the central bank is expected to raise rates. And finally, over in crypto land, Bitcoin dropped back below $40,000, erasing nearly all the gains sparked by optimism about US President Joe Biden's executive order on crypto, as digital currencies fell with stocks on Thursday amid high inflation data and continued geopolitical uncertainty. The largest cryptocurrency declined as much as 7.9% to 38,582 on Thursday, falling for the first time in 3 days. Ether fell as much as 5.7% to 2,553. Now, it's interesting that in recent years, Bitcoin has demonstrated a tendency to follow moves in the stock markets. A 50-day correlation coefficient between the token and the S&P 500, one of the most watched US market gauges, stands at 0.5%, with a score of 1 equating to lockstep move. In terms of risky assets, digital currencies fall on the far end of the spectrum, according to Callie Cox, US investment analyst at eToro. Yet, in a survey of 100 institutional investors and wealth managers, 73% saw Bitcoin as a viable hedge against inflation, according to research commissioned by London-based Nickel Digital Asset Management. Based on the way that crypto works, naturally it could be a good inflation hedge, Cox said. But with all the speculation wrapped up in it, and with all the money that you're seeing with it being an emerging market and taking steps to becoming a mature market, it may not be acting like an inflation hedge right now. Bitcoin jumped, of course, as much as 11% on Wednesday amid optimism about the trajectory of US regulation of digital assets, as the framing of Biden's executive order on cryptocurrencies was made clear. But, however, those gains proved fleeting as traders digested the news, and the token is again trading near the middle of the range where it spent most of the past 2 months. Although the initial reaction to the Biden digital assets executive order was it's not as bad as it could have been, a closer look at the details shows that it does not remove potential regulatory risk, said Jeffrey Halley, senior market analyst at Onda Asia Pacific. So once again, there is considerable volatility ahead as we go up the ladders and down the snakes. These markets are crazy. More concerns about inflation and higher interest rates, and also the spectre of stagflation and depression is definitely haunting the halls. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.